Hello, welcome to the Gorringe Accountants 2025 Autumn Post-Budget webinar for business owners. I'm Nikki Larkin. I am the founder and director of Gorringe Accountants, and I will be taking you through the main things in yesterday's budget that are relevant to business owners. So, there's quite a few different things to go through. If you have any questions, please do feel free to contact me after this, and I'd be delighted to go through anything with you. So what I'm trying to do today is I want to help you see how are SME business owners affected. What can we do to offset the rises, and how can we still grow our businesses? So what happened yesterday in the budget, which was actually leaked, which was a bit novel. So it wasn't just a one-off last year of £40 billion extra being needed to be raised in tax, because yesterday another £26 billion were to be raised in future taxation. So this affects business owners in lots of different ways. These are a summary of the items that I'll be going through today. We'll be touching on dividends, pensions, EOTs, income tax for landlords, EMI changes, EIS and VCTs, mileage rate on electric vehicles, cash ISAs and child benefit. But what I'm particularly wanting to do is not just talk about what the changes are, but how you as a business owner can hopefully mitigate or benefit from the change. So firstly, this will be affecting the majority of business owners. If you own a limited company, you are probably paying at least some of your money to yourself via a dividend. Dividend rates have been increased by 2%, and that is effective from 6th of April 2026. So in this current tax year, we're currently in 25 to 26, you'll still be at the old rates at 8.75 and 33.75. But from April, they will be increasing. Interestingly, the additional rate has not been touched, so that is still 39.35%. That was a bit of a surprise because they keep talking about taxing the higher earners, but they're really going to be affecting a lot of middle earners here that are being affected up to the £150,000. And most business owners that I know are generally taking somewhere between £50,000 to £150,000 through a mixture of salaries and dividends, etc., from their businesses. So this is going to hit a lot of people hard. What I've given you a few little examples here. So you may be having a whole variety of decisions of how you actually take your salary. But if you take sort of around your personal allowance, so £12,500, and then you take £37,500 in dividends, that means that your effective tax rate will be 10.61%, and you will have to pay on those dividends in the tax year £3,978. Now that tax would be paid in January 28, so it's a little bit of time, but effectively it's another, for every £10,000 of dividends, it's another £200 of tax you will need to pay. So it's good to think about it in those sorts of terms. So every £1,000 is another £20. So I've given some examples here. There's a lot of business owners that like to, if they're actually quite well off cash wise, they may just want to pay themselves up to the higher rate threshold and leave the rest of the money in their business. And so that's why I put in a 50,000 scenario here. But I've also put in a scenario for those that are looking to have just under the £100,000 threshold, which is, of course, when you lose your personal allowances. And that is, a really nasty effective tax rate over the 100,000. So it's a 35.73% effective tax rate for those that are taking 92.5 from the 12.5 salary and 80,000 dividends. So, quite a significant tax bill, 18,979. So what can you do? So firstly, think about what dividends do you need for this year and next year. If you're needing quite significant ones next year, do have a think about whether it may be sensible to increase your dividends this year instead. But be very careful, because especially if they're going to be taking you into different tax bands, so you need to be very careful how you're doing your forecasting. And of course, if you're taking dividends earlier, that means that will be bringing the tax earlier. So instead of paying dividends in January 2028, if you were taking a dividend after the 6th of April, that means that you would be paying your tax in January 2027. And of course, cash is often king, and the cost of cash you've got to bear in mind. So if you're going to be paying significantly for having to pay for that tax bill, if you're having to borrow it or use your overdraft or whatever, you might just think, well, actually, let's just leave and let's just delay the dividends as long as you can. Of course, it's always good to look at how else you take money out of your business. So first of all, really basic, make sure you reimburse yourself for expenses. Often busy business owners forget to do this because they're so busy. So they forget to calculate their mileage or claim for their parking tickets, or not the penalty parking tickets, to be clear, but for general parking. But also it might be if you're taking out perhaps a prospective client to a lunch or a dinner, they may think, oh, well, I can't claim for it because you don't get corporation tax relief or VAT relief because it's a business entertainment. Yes, but think about who's going to be paying for it. Surely it's better for the business, the limited company, to pay for it rather than you take it out through a director's loan or a dividend, because you're going to have to pay tax on that. So keep that business entertainment costs in the company as long as they are legitimate business costs. So firstly, of course, so as I said, take out those expenses. Also have a look at your pensions. It can be very tax efficient to put money into pensions, especially if you're doing an employer contribution. You can then get your corporation tax relief. So just have a look at your mix there. So have a look between your salaries, your dividends, your expenses, to make sure you're getting the right mix. Also, rental, if you don't have offices and premises, make sure you're using at least the work from home allowance, and potentially even be looking at potential rental charges. But be very, very careful how you do that. Make sure you do that correctly so that you don't end up with another tax bill that you weren't expecting. The other thing to note, which is very important, I've been talking about those business owners sort of earning between 50 to 150,000. Or actually, if you're wanting to earn more than 200,000, you may find that it's more tax effective, to actually take that all as salary. So do get a calculation to check which is best for you and your business, because you may find that over the £200,000 threshold is better for you to be taking it as a salary. Of course, if you're just starting up, you might be thinking, well, do I really want to be setting up as a limited company? And, legitimately, perhaps you do want to just set up as a sole trader instead, because surprisingly, the tax at a sole trader can still be cheaper if you're wanting to take significant money out. What I always say to those that are taking out a significant amount, so for example, I did a scenario a couple of years ago, somebody that was looking at earning around 300,000, because they needed the cash for a variety of things, that it actually worked out much better for them to be actually registered as a sole trader and just be taxed on that income then, rather than put it through a limited company, pay corporation tax and dividends. It's still better as a sole trader. So be very careful. Obviously, tax should not be the only decision for how you structure your business, though. So to carefully think about all the different scenarios, and do get advice from your tax advisor. You know, literally just 15 minutes, sit down, can sometimes save you a huge amount of money. Pensions. This is something that has been talked a lot about before the budget. We now know what the change is. And it's not for quite a while. It's not till April 2029. So who knows if it will actually come into fruition. However, if it does, what they're talking about is the salary sacrifice cap. So that's where an employee contribution is converted into salary sacrifice, and it means that they don't have to pay any employee national insurance, which gets a good saving. But what's happening is that's going to be now only the first 2,000 per year on the salary sacrifice is going to be NI exempt. So this won't affect the lower earners, but if you have got mid earners, higher earners, this is going to be quite significant, and you may want to have a look at what's going to happen. Obviously, software is not in place yet. This is all brand new, so we have to see. They've got a few years now to catch up. But what I would be suspecting, it's probably still going to be best to still use a salary sacrifice up to the 2,000 and then just do normal contributions after. But we'll have to wait and see. It may be that there might be some IFIs or pension providers that come up with some clever different options, but we don't have to worry too much yet because it's not for quite a few years. But when it does come in, it can be quite significant. And of course, you want to try and maximise your pension. Now, this is an area that you may not know because it's quite a small area. There's not that many businesses that end up going into these. It is an employee ownership trust. So if you've been running your business and you're wanting to exit, this is an option for you. You, instead of doing a third-party sale or a traditional management buyout, or even just shutting up shop, then you may want to consider selling your business to an employee ownership trust. Now, it's quite complicated how it gets set up. You do need to make sure that you have experienced accountants and lawyers setting this up. But effective from yesterday as in the 27th of November, yesterday as in the end of yesterday, so today, so from today, the 27th of November, the capital gains tax relief, which was at 100%, has now been reduced to only 50% relief. This is extremely significant because that was one of the big reasons why employers were selling to the EOTs compared to selling to another third party, because of the huge tax saving. It's going to be on capital gains tax, so at the standard rate, so 24%, assuming that the seller has already used up their basic rate. So you're going to have to pay 12%. This sort of scenario, this sort of trust, was lots of people think it's really interesting and get quite attracted to it. I tend to find that very few end up going for it for one reason or another. And unfortunately, I think this is going to really be almost the death of these types of trusts going forward for any new ones. If, however, you have got a very cash-rich business, this may still be an attractive option for you. So, don't completely disregard it, but it may just mean that it might be a bit of a quicker look than previously. Now, this was something different, income tax for landlords. So essentially, income tax for landlords is going to go up by 2%. So if you are currently paying 20% on your rental income from a rental property or your Airbnb rental income, you will now be paying 22%, or if you're higher rate, 40, go to 42%, etc. Now, this is not great. This may mean that where landlords were getting slimmer and slimmer profits, this may just be the final nail in the coffin to them, and they may decide, right, that's it, I'm going to just dispose of my rental properties. Alternatively, where they might decide is they might look at a different structure. So they might look at transferring them into a limited company. There can be some advantages to that, but it may not be appropriate for all rental portfolios. So again, make sure you take proper advice on that, because it will depend. Do you have a mortgage on those rental properties? Do you need to use the income, or are you able to build that up over time? And those sort of things can make a lot of difference between whether it's actually sensible to put it into a limited company or do something else with it. For example, dispose of them. So it's a bit of a shame. Landlords are being really squeezed. I'm seeing less and less people being attracted to being a landlord. Which is meaning a lot less rentals on the market. Certainly, I know a lot of my younger employees who are still renting. It's getting a very, very hot market for rental. It's very difficult to find them. So I'm hoping that if the private landlords do decrease, I hope that there will be an increase in housing associations with more properties, but we will have to wait and see. The next area, another bit of a niche area really, enterprise management incentives, EMI. So you may have had these at some point, either when you were an employee yourself, or you may be dishing them out to your employees. They are a type of share ownership. So in EMI, what they're doing is that, they're trying to make this a little bit wider by increasing the thresholds of which businesses can utilize this incentive. Also, which is very useful, is the exercise windows are being increased from 10 to 15 years, which is super useful. I did notice that the ratio of the gross assets to the total value of options grants has not equally been increased. So essentially a smaller percentage of that company can be under EMI options. But hopefully it does just give the an incentive for some more staff. I would just word of caution, EMI is not appropriate for all businesses. Also, do make sure you set it up properly. I've seen where people have used careless advisors, not had them set up properly, and their employees have ended up losing hundreds of thousands in tax on exit because they ended up having to be fully taxed because they weren't set up properly. So if you are going to look at EMI, please make sure you do use a really good provider. Don't just go for the cheapest, because it may look very exciting that great, it's only £1,500 or something, but trust me, if they're doing it like that, it's unlikely either it's going to be a boilerplate and you're not going to be able to personalize it for your circumstances in your business, or it may just not work. So please be very careful, because it might be saving you a few hundred now, but it could be extremely expensive later. Also think about, is it really suitable for your business? I see EMI schemes as being useful for businesses that are on a good growth track. If you are in a stagnant business or it's in decline, it's not going to be appropriate. Well, you've got to carefully consider whether that is the right type of share scheme for your company. I also wanted to mention EIS and VCTs. So these reliefs, they're going to be allowed to be applied for larger businesses, which is great. So I've put on the slide there, you can see. So we can, instead of just gross assets of 15 or 60 million before and after, can now go to 30 to 35 million gross assets. Also, the annual amount of fundraise per year is going to be increasing, which is great news. So there's lots of really good things, because this is good message about investing in growing businesses, the scale up businesses, which is really good. But notice the thing at the bottom. Unfortunately, VCT relief currently at 30%, so very attractive. albeit only 24,000 people actually utilise it in this country at the moment. But that is being slashed by 50% down to 20%. So if you are do have venture capital dividend venture capital shares, just notice that your relief is going to be really reducing. However, there's still other good incentives with it, as in you don't pay any tax on those dividends, and there's still capital gains tax free. So there's still lots of really good things about it, but just be careful about the full rules are there. And also, again, if you do utilize any of these things, make sure you're using a kosher advisor, and also make sure, if you're the company putting them in place, that you are using somebody that is very experienced. Because again, you don't want to find that you've raised a lot of money and then your investors can't actually claim it. That will not be a great look. So, but there's plenty of good fund managers and different advisors out there who are very experienced and can do this without any problem. This one, I am particularly disappointed about this change, and I don't even have an electric vehicle at the moment, so it's not even that I've got any skin in the game with this one. But they are putting, the government in their wisdom is putting in place a pay per mile charge, 3 pence per mile. Also applying to many hybrid vehicles, 1.5 pence per mile. This is effective from the 6th of April 2028. So therefore, if you have decided, actually, now this is just one thing too far, I don't want my electric vehicle anymore, you've got time to dispose of it before then. It's not fully clear how it's going to be in place, but it sounds like it's going to be some sort of annual charge, and you're going to have to do some estimates of what mileage you are. But to me, I try not to give my personal opinions on this too much, but personally, I think, one, you should still be promoting greener things, better different types of energy, etc., and to put in another tax, another level of bureaucracy, is, I think this one is really disappointing. So I think it's a real shame. ISAs. So at the moment, if you use a cash or stocks and shares ISA, you can put £20,000 in there every year. However, from 2027, you're not going to be able to put all of it into a cash ISA. The cash ISAs are going to be reducing from 20,000 to 12,000. I've just noticed this slide could be a bit misleading if you're just reading this and not listening. But yes, the cash ISA is going to reduce to 12,000. Therefore, they're trying to encourage people to utilise the cash and stock, the stock and shares ISA more. Still not going to be applicable to those over 65. They're still going to be allowed to use their full allowance into cash ISAs. But yes, I think markets will like it. The investors who want to have a little mix, I don't know, but it is what it is. At least we still have got 20,000 being allowed to go into an ISA, which is good. Child benefit. So this shouldn't be too much of a surprise to anybody. The child benefit has been, the child limit has been scrapped. So from April, if you have more than 2 children, then you can claim for child benefit for all of those children. Now, the reason why I'm putting this in a business slide is I want you to be really thinking about your employees, or it could be for your own mixture of remuneration. So these, at a certain level, around 60,000, it kicks in that you start losing this benefit. So be very careful. So if you're trying to incentivize an employee, you might find that just some tiny pay rise is not going to cut it, because, especially if it means that they're going to lose some of their child benefit plus the 40% tax, etc. So just be mindful about what levels people are at. So I just be very careful with that. What some people will do is they might just opt out and not even claim it. I still think it's quite a good tax-free loan. You've just got to remember that you've got to pay it back again. at the end of the tax year, or when it comes up to you paying your tax. But it's up to you. You might just think, oh no, it's just a bit of an admin too far, and opt out. Or you might just want to do that. Also bear in mind that it comes out from the, if you have two parents in the home, then it comes out of the higher earners tax return. So you may find that one person is receiving the child benefit and the other one is paying it back again on your tax return. So just have a look. Just also be looking at, perhaps you want to reduce how much, what level of dividends or salaries you're taking to ensure that you still can have your child benefit. It's just something else to think about in your mix. So those are the main things. The only other thing I did really want to mention was the national minimum wage. That's increasing again from April 2026. For 21s and overs, it's going to £12.71. That's £12.71, which if they are on a 37.5-hour week, that means that they would be earning just under 25,000. 18 to 20-year-olds will be at 10.85, which is just over 21,000. 16 to 17-year-olds at £8 an hour, which is 15,600. If you have any deductions on your payroll, be very careful that you're not going to breach the national minimum wage rules. So be super careful there. Do get advice from your payroll team or your HR department or your tax advisor, because you really, really don't want to have a national minimum wage issue. Anyway, thank you so much for taking the time to watch this. I hope this was useful. Any follow-up questions, please do feel free to reach out to me on LinkedIn or contact the team at Gorringe Accountants with the number here, 0118 914 4500, or myself, Nikki Gorringe-Larkin, on LinkedIn. Thank you so much for your time. Thank you. Hopefully you have a great year.